Most investors get this backwards. They chase hot stocks. They follow tips from their brother-in-law. They buy whatever made headlines last week. And they wonder why their portfolio goes nowhere. The problem is not the stocks. The problem is how you choose them. Today I want to show you a different approach, a framework that answers one simple question. Which companies deserve your money for the next 10, 20, even 30 years? We call it the three buckets. And once you understand it, you will never look at stock picking the same way again. Here is what we will cover. First, I will explain why most companies fail to meet their shareholders' expectations. It is called the agency problem, and understanding it changes everything. Second, I will walk you through each of the three buckets and show you exactly what we look for. Third, I will share real-world examples that demonstrate how this framework works. Let's start with the big question. Why do most companies disappoint their shareholders? If we have not met, I am Burke's AI avatar. I provide financial content for free, so you do not have to pay. David Berkowitz, the lead at VAP Wealth Advisors, trained me using 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he is meeting with clients and researching quality companies. He reads every comment and writes every lesson. Imagine you own a rental property. You hire a property manager to manage it. You want them to keep costs down, find good tenants, and maximize your rental income. But what does the property manager want? A bigger budget, less work. Maybe they hire their cousin to do repairs at inflated prices. Your interests and their interests do not line up. This is the agency problem, and it happens every single day in public companies. Shareholders provide the money, they take the risk. They want long-term growth and smart decisions. But managers? They want bigger salaries, larger budgets, fancy acquisitions that make them look important. Two professors, Jensen and Meckling, wrote about this in 1976, and nearly 50 years later, it remains the central challenge in corporate governance. The question is, how do you find companies where this problem has been solved? That is exactly what the three buckets framework does. It identifies companies where managers think and act like owners. Let me show you how. Bucket number one, ownership companies. These are businesses where the people making decisions have real money on the line, not stock options that vest in 3 years. Real substantial wealth tied directly to whether the company succeeds or fails. There are four types we look for. First, founder-led companies. Think about it. The founder built this business from nothing. Their reputation, their legacy, everything they have worked for is wrapped up in the company's success. Research from Harvard Business School found that founder-led firms outperform the S&P 500 by 3.9% annually. Let that math sink in. If you invested $100,000 and earned market returns, after 30 years you would have about $1.8 million. But in founder-led companies, $2.8 million. That is $1 million difference from alignment alone. Second, family-owned businesses. These families think in generations, not quarters. They are building something to pass down, not maximizing short-term bonuses. Credit Suisse tracked family-controlled companies globally. They outperform by 3.7% annually. They carry less debt. They stay conservative when competitors overextend. Third, companies using value-based management. These businesses treat capital like it has a cost. They measure value creation after subtracting the opportunity cost of money. They tie executive compensation to long-term value, not arbitrary targets. Studies show these firms outperform the S&P 500 by about 7% annually. Fourth, companies backed by private equity. These firms install ownership operating systems during private ownership. They concentrate stock in management hands. They demand performance. Even after going public again, these companies often maintain that discipline. The pattern across all ownership companies is consistent. When decision makers have substantial economic skin in the game, they behave like owners. The agency problem fades away. But ownership is not the only solution. Let me show you bucket two, monopolies and oligopolies. These companies solve the agency problem differently. They have such dominant market positions that even mediocre management cannot destroy shareholder value. Warren Buffett calls this an economic moat, a structural competitive advantage so powerful it protects profits for decades. Look at Google. They control 90% of global search. More users generate more data. Better data improves results. Better results attract more users. The moat strengthens itself. Competitors spend billions and barely move the needle. Or consider Visa and MasterCard. They process over 90% of credit and debit transactions in America. They operate a toll booth on electronic payments. Small fees on trillions in volume. The business requires almost no capital. Operating margins exceed 50%. No competitor has breached their duopoly in decades. Charlie Munger, Warren Buffett's longtime partner, put it perfectly. One competitor is enough to ruin a business. Monopolies and oligopolies face no competitors, or just one manageable competitor. This structural advantage means management can make mistakes and the business still prints money. With ownership companies, aligned incentives drive results. With monopolies, the moat protects shareholders even when management is imperfect. But there is a third bucket, and it might be the most revealing of all. Bucket number 3, cannibal companies. Strange name, right? Charlie Munger came up with it. These are businesses that consistently eat themselves by buying back their own shares. And when done right, it is the most unmistakable evidence of management alignment with shareholders. Here's how it works. When a company buys back shares at prices below what the business is worth, remaining shareholders own more earnings, more cash flow, more assets per share. If a company earns $100 million and has 100 million shares, earnings per share equals $1. Buy back 10 million shares, and earnings per share jumps to $1.11. That is an 11% increase without any operational improvement. Let me give you a real example. AutoZone. Over the past 25 years, AutoZone reduced its share count by more than 88%, from about 150 million shares down to under 18 million. Management bought aggressively during recessions and market corrections. When the stock got cheap, they loaded up. The results? Earnings per share grew 91 times. The stock price increased more than 99 times. $10,000 invested in AutoZone became nearly $1 million. AutoZone management did not revolutionize the auto parts industry. They ran a steady business well and made one exceptional capital allocation decision repeatedly: buy back undervalued shares instead of chasing growth for growth's sake. That discipline proved alignment. Every buyback said, "We are owners and we are increasing our ownership of this cash flow stream." Now, a critical qualifier. Not all buybacks create value. Repurchasing overvalued shares destroys value. Management teams buying back stock at peak prices with borrowed money are either incompetent or misaligned. The cannibals we invest in demonstrate consistent, countercyclical programs. They accelerate buybacks when prices fall. They slow down when valuations stretch. So let us bring it together. Bucket 1. Ownership companies. Aligned incentives through founders, families, value-based management, or private equity structures. Bucket 2. Monopolies and oligopolies. Competitive moats so wide that even imperfect management generates exceptional returns. Bucket 3. Cannibal companies. Capital allocation behavior that proves management thinks like an owner. Together, these 3 buckets create a focused portfolio of 15 to 20 world-class businesses. Companies built to compound wealth across market cycles and decades. We are not hoping for good management. We are investing where alignment is structural. The agency problem will never disappear. As long as owners hire managers, misalignment will exist. But investors do not need to solve the agency problem everywhere. We just need to invest in the subset of companies where it has already been solved. Now, here is the thing. Identifying these companies is one thing. Building a complete portfolio that fits your situation is another. If you are serious about compounding your retirement for the long term, if you want to own companies that double their share value every 3 to 5 years, if you value working with someone who thinks like an owner, not a salesperson, I'd like to invite you to schedule a free review of your 401k options. The link is in the description below. We will look at what you currently own. We will identify whether your portfolio aligns with these principles. We will map out a path forward that aligns with your goals. And if you want to go deeper on any of these concepts, watch this video next, where I break down how we evaluate whether a company's moat is getting stronger or weaker over time. I will see you there.